Okay, let's dive right into this. Welcome to our latest explainer. Now, have you ever looked at a company's financial statements and just felt like you were staring at a giant wall of meaningless numbers? Look, you are definitely not alone in that. Most people just see dense spreadsheets, endless rows of data, and, well, overwhelming complexity. But today, I want you to completely change how you view those documents. Actually, scratch that. Stop thinking of them as boring spreadsheets altogether. Instead, I want you to think of them as a detailed medical chart. Think about it. A doctor wouldn't just look at a patient's outward appearance and guess if they're healthy, right? In the exact same way, we can't just look at a company's flashy logo or a single stock price and know its true condition. We need to run some tests. We need a diagnostic checkup. And that is exactly what we're going to do today by demystifying financial ratios.
So, I want to ask you directly, how do you measure a business's true health? Think of all those companies that reported astronomical, record-breaking revenues, only to suddenly file for bankruptcy just a few months later. Why? Because their costs completely outpace their available cash. A massive revenue figure or a huge pile of assets is honestly just a vanity metric if you don't connect the dots. A company doesn't automatically survive tomorrow, let alone thrive next year, just because that top-line number looks fantastic. To figure out the true story, we absolutely need a way to connect those raw numbers together to give us real context.
And that brings us to the core of our diagnostic toolkit today, the ratio. A ratio is simply a tool used in the analysis of financial statements to interpret a company's performance. You can think of a ratio as the blood test of our business health checkup. It literally takes two distinct data points from our financial medical chart, like, say, total debts on one side and total equity on the other, and compares them. By creating this mathematical relationship, the ratio extracts incredibly meaningful insights from all that dense financial data. It transforms raw, boring data into actionable intelligence.
So, to evaluate a business's vital signs today, we're going to check four main areas. 1. Liquidity, that's the pulse. 2. Capital structure, the skeleton. 3. Turnover, the metabolism. And 4. Profitability, the scoreboard.
All right, let's start with Section 1, liquidity, the pulse, which measures short-term solvency. When a doctor checks your pulse, they're making sure your heart is beating right now, right? Keeping you alive in the immediate moment. Well, for a business, liquidity checks if you have the immediate cash or at least assets that can be quickly turned into cash to survive today. Because if the short-term solvency pulse stops, the business dies, regardless of how amazing its long-term plans might be. To measure this pulse, we rely on two absolutely crucial metrics, the current ratio and the quick ratio. The current ratio looks at all of your current assets and compares them to your current liabilities. It's a broad look at whether you can cover what you owe over the next year. But what if an emergency hits today? That is where the quick ratio comes in. The quick ratio is a much stricter stress test. It strips out inventory entirely. Because, let's face it, if you desperately need to pay a supplier by Friday, you can't exactly guarantee you're going to sell all your warehouse stock by Thursday night. The quick ratio tells us exactly how much pure, immediate, liquid lifeblood the company has pumping through its veins right this second.
Moving on to Section 2, capital structure, the skeleton. Here we're evaluating long-term stability. And you know, what's really interesting about this is how it forms the foundation of everything else.
See, while liquidity keeps you alive today, a business needs a really strong skeleton to bear weight and grow tomorrow. If that skeleton is made entirely out of debt, it's incredibly brittle. The slightest market shock could cause the whole structure to just fracture and collapse. To examine this skeleton, we use capital structure ratios. The debt-equity ratio tells us how much of the business is funded by borrowed money versus money actually put in by the owners. The proprietary ratio flips that lens slightly to show the proportion of total assets financed directly by the owner's equity. And then, oh man, we have the interest coverage ratio. This is a vital checkup. It measures how comfortably a company can pay the interest on its outstanding debt using its current earnings. Because if earnings are barely covering the interest payments, that skeleton is under immense, dangerous strain.
Up next is Section 3, turnover, the metabolism, where we check resource efficiency.
So, a high metabolism in a person efficiently converts food into energy. For a business, turnover metrics show how well management metabolizes its resources into sales. Let's break it down. Inventory turnover shows how many times a company sells and replaces its stock of goods. If this is slow, your inventory is just sitting around gathering dust, and that is trapped energy. Debtor turnover measures how efficiently the company actually collects cash from the people who owe it money. Fixed asset turnover and capital turnover evaluate how well the company uses its heavy machinery, its buildings, and its overall invested capital to generate revenue. Together, all these turnover metrics measure the pure efficiency of resource use.
Simply put, the faster the metabolism, the leaner and more dynamic the business.
And finally, Section 4, profitability, the scoreboard. Let's move to this and see how it all builds up to evaluate our ultimate returns.
You can have a steady pulse, a super strong skeleton, and a blazing fast metabolism. But if you aren't actually creating value, the business will eventually starve. This is where we bridge our medical checks to the ultimate outcome, the scoreboard. Profitability is the scoreboard. But keep in mind, not all profit is created equal. We start at step 1, gross profit. This evaluates profitability relative to sales after just stripping out the direct, raw costs of making the product. Then we step down to step 2, the operating ratio. This factors in the daily, grinding expenses of running the business. Keeping the lights on, paying the staff. Finally, we arrive at step 3, net profit. This is the absolute bottom line. This is after taxes, interest, and literally every other expense has taken a bite out of that original dollar. It shows the ultimate profitability of the core operations.
But beyond just net profit, we really have to view the scoreboard through two completely distinct lenses: profitability relative to sales and profitability relative to capital. Understanding this difference is absolutely everything for an investor. Metrics like return on investment, or ROI, and return on equity, ROE, show us exactly how much profit the company generates based on the capital it actually has to work with. Meanwhile, metrics like earnings per share, dividend payout, yield, and price-earnings ratios help investors understand what kind of return they're getting for the specific price they are paying for a piece of that business. It evaluates the absolute efficiency of capital allocation.
So we've covered a lot of ground today. We've looked at the pulse of liquidity, the skeleton of capital structure, the metabolism of turnover, and the ultimate scoreboard of profitability. So, which ratio tells the true story? The answer is that no single ratio holds all the power. A healthy pulse means absolutely nothing if the skeleton is crumbling from debt. And high profitability? It's a complete illusion if the company is severely illiquid and about to bounce its checks. The next time you hear a company boasting about record profits, ask yourself, is their skeleton made of debt? Are they about to flatline from a lack of cash? Don't just trust the logo. Run the diagnostics. What hidden sickness, or maybe what hidden strength, will you uncover in the ratios? Thank you so much for joining me for this explainer, and as always, keep learning.